This is Market Pulse by Faster Forward at Northern Trust Asset Servicing, the podcast where experts share their insights on the markets and financial landscape. My name is Marc Mallett, Chief Strategy Officer for Northern Trust Asset Servicing, and I'm joined today by Grant Johnsey, Head of Client Solutions for Banking and Markets Americas. Grant, it's great to have you back on the Faster Forward podcast. I look forward to hearing from you about what's going on in the markets. I thought we could sort of jump in today's discussion, maybe just get your thoughts on what are the latest trends and anything noteworthy that you're seeing in the markets at the moment.
Sure. Well, clearly it's a pretty strong bull market right now, and I won't go through the normal stats that most people are well aware of, but I will point out a couple of them. So one is we haven't had a down 2% day on the S&P 500, nor a down 2.5% day in NASDAQ for over 300 and I think 30 or 40 trading sessions now. So that's getting to be one of the longer ones in recent history. The longest by comparison was around almost 700 days and the odds kind of leading up before the financial crisis. So not to say that it's going to lead to that or we're going to have a 2% down day in the near future, but we have had a very long run of positive days. So still a lot of buying that's there. We see a lot of foreign buyers still active, particularly in the U.S. equity market. Bonds have continued to perform well. In fact, if you look at this year from the end of last year, we've added, since really the November lows, I would say, we've averaged added about $12 trillion in value to the S&P 500 over that time period. So it's an unbelievable run in the market. So with that being said, the question that I oftentimes get asked a lot are twofold. One, is this a bubble? And it's not a bubble, it's rich valuations clearly, but right now we're at about a PE in the S&P 500 of 21. So we were 19, towards the end of last year. So we've seen some multiple expansion, but earnings growth still very positive. And, earnings are expected to continue growing through this year, pretty strong earnings expectations. So the forward PE is 21, up from 19. The top 10 names are about a PE right now of around 31. So that's getting high, it's getting rich for those mega cap names. So a little bit of a concern there, but typically speaking, mega cap rallies are followed by positive returns a year later, about 3/4 of the time. So again, not a particular concern there. The other interesting thing, if we compare the AI buying spree relative to what is in hindsight a bubble of the dot-coms 24 years ago. Right now we're at about the same amount of the S&P 500. About 40% of the S&P 500 right now is a mix of telecom, communications, and technology. All right. That's the same as it was in 2000. The big difference, though, is that the earnings that those names in the tech and communications represent today is around 34% of S&P 500 versus something in the mid to high 20s in the dot-com bubble. So there's a lot better earnings support behind this.
So these are more real businesses than maybe some of the dot-com companies.
There's a couple of things you start to worry about. So NVIDIA, if you look at their earnings carefully, their backlog of buying has slowed. It was about a year to get one of their GPUs. Now it's 3 to 4 months. And you do see some sort of froth-like activity. As an example, there's a recent acquisition that Blackstone just finished this month in a smoothie operator, a tropical smoothie franchise, where they ended up paying something like $1.4 million on average per franchise. So you start to see a little bit of rich valuations that are out there, I think. The other thing with NVIDIA that's curious is that they have been sponsoring they have actually an investor in a cloud startup, a cloud computing startup that has a heavy focus on AI. They've been selling them and giving them a lot of their chips, even though they've had a backlog. So giving them some preferential treatment in terms of getting them to buy their chips. And then that company actually is using those chips as collateral to buy more infrastructure, which includes more chips. So they've actually issued $10 billion of debt where the collateral is NVIDIA GPUs. And NVIDIA is an investor in this. So you start to see, all right, is that eventually going to slow down or pop at some point? And, it's probably inevitable. But right now, their earnings are fantastic. Their growth is strong. And there's not much that I see right now that's real froth compared to, say, where we were, in 2000.
So is there anything you're seeing changing, sort of investor behavior, just, given that, sort of the continued bull market and maybe some of the concentration in something like NVIDIA?
Yeah, so I always tend to look at the retail investor, right? So we've talked about this in the prior podcast, between direct investment in the U.S. equity market as well as mutual fund, some more indirect ownership. Retail investors are more than half of the investment into the U.S. stock market today. And so I pay attention to what are the retail investors doing. And retail investors right now are 70% exposed to U.S. equities. That is the fourth time in 20 years we've hit that level of concentration. Now, I went back and looked at the prior 3 times, and it's impossible. The results after that, we hit that 70% number, are kind of all over the place. So it's hard to draw a conclusion off of hitting that type of allocation. But clearly, the retail investors don't have a lot of fresh capital to put into the market, given that they're already 70% long. If you look at the AAII, the American Association of Individual Investors, they do a survey. It's public, anyone can go look it up. The bullish sentiment is relatively high, but it hasn't driven that much higher over the last month or two. What has changed is the bearish sentiment has declined. It's about 22 or 23% surveyed now are more bearish, which is very low. It's the lowest it's been in recent history. So what I'd say about the retail investors is they're not piling in anymore. In fact, we've had about a month and a half of moderated retail purchases in the equity market. It's part of why we saw a little bit of a softening in April and May in the equity market. So they're not buying as much. So I do see that as potentially something that might see us have a little bit of moderation in price. The other 2 things I would look at, corporate buybacks are starting to slow a little bit. And then traditionally, historically, heading into an election, we do tend to see investors peel out of the equity market. That has not happened this year. And if that didn't happen headed into the November election, that'd be the first time, at least the last 4 or 5 elections, that has not happened.
And so, Grant, I wonder, is some of the, I suppose, the fact that the retail investor doesn't have much more sort of headroom from the equity perspective, at least sort of allocating to equities, is some of that tied to the fact that savings were up so high, post the pandemic, or I suppose during the pandemic. I keep hearing that we're seeing that those savings balances start to also decline. So they're burning through a lot of that savings, don't have as much free cash.
Yeah, possibly. I think we have seen a savings that happened during the pandemic. We've talked about it. I think most listeners are probably very familiar with that, through not spending as much during the pandemic, plus all the stimulus that happened during that time period. But if you actually go and you look at the numbers from the BLS and from the Fed, it's actually the savings that is there has gone down. For the amount of savings has dissipated for all income. But what's really fascinating is the lowest 40% of wage earners in the United States are now have less savings than they did before the pandemic. The top 60% earners still have more savings. While they're off the peaks of a couple of years ago, they still have more savings than those higher earners did than they did previously. And that's where we're kind of continuing to see the market still go higher, more consumer spending. I saw a stat on European vacations, or vacations out of the country for Americans, is as high as it's ever been. So those that have, there's very much a dichotomy right now. Those that have money, who are not exposed to, consumer lending, that don't have big credit card bills, or not having to finance, automobiles and the like, right? Those folks are in a much better spot. They've usually have much more equities. We just talked about how the S&P 5 is up 12.5 trillion over the last 7-8 months. So they've got a lot more wherewithal, and there's still some savings that's there. And I think that's what's going to continue to drive the economy. But you are seeing a smaller proportion of those lower wage earners. While they have had good wage growth over the last few years during the pandemic, the issue they're faced with is that they've drawn down a lot of those savings, and they are now actually have less savings than they did before. Credit card delinquencies have been marching up a lot. Again, that's probably more of those lower wage earners. And look at auto loans. Auto loans are also problematic right now. They're starting to go up in delinquencies. 90-day delinquencies are going up there too.
So as much as we're saying, it doesn't. There are differences to the financial crisis. I'm hearing a lot of similar trends, whether it's delinquencies, I suppose, is there anything investors should be doing, we're not predicting that this is going to happen, but is there any way for investors to start thinking about hedging, some of the risks of, a potential downturn?
Yeah, the thinking sometimes is this time is different, but they are never different. That these cycles always rhyme. So again, I don't see anything that's particularly concerning in the near future. I think from a technical standpoint, we are due a bit of moderation in the U.S. equity markets from a technical side, but I don't see anything fundamentally that's going to cause a lot of issues. There's very little hedging going on right now. If you just look at the put-call ratio and the listed option market in the U.S., very little hedging, with one exception. If you look at the VIX futures, they are spiking in October before the election. So there's some hedging that is going on in the election. People start to think about what may or may not happen leading up to what's going to be very contentious.
So is that indicating an expectation of higher volatility around in and around or on the other side of?
Yeah, it is. It's looking at higher equity volatility. Now, what's really curious is the cost to hedge the U.S. dollar right now globally is actually higher, meaning more people actually expect the U.S. dollar to strengthen. So, a little bit of a, confusing signal from the market. But the only real hedging that I see right now is in the, kind of that October, November timeframe coming from the U.S. stock market. But at the end of the day, I think the hedging that is, probably should be happening is more diversification. I think that's probably the route that people need to probably look at, as opposed to outright hedges on the overall market. Because again, the market fundamentally, and from at least economy in the United States, still looks fairly robust.
So Grant, I know we talked in the November podcast about liquidity, government spending as being some additional concerns. The CBO just came out with a report, I think it was last week, where it looks like the spending this year is going to be up significantly from where they had originally anticipated, so up to about 1.9 trillion. That's a concern. Anything else that you take away from that, that you think investors should be considering?
So, the CBO report that came out very recently was quite alarming. So 1.9 trillion is the expected fiscal year 2024 shortfall. In February, they actually estimated to be 1.5 trillion. Why was it so much higher? There's a number of factors that get into it in the CBO. The one that really jumped out to me is 70 billion of that is because they have a shortfall in FDIC payments. So the FDIC is what supports the bank deposits up to $250,000. I think, as everybody's well aware, we had the mini banking crisis in the late winter of 2023, and the Federal Reserve decided to bail all those banks out because so many investors had not paid any attention to the $250,000 limit and had far in excess of that. It would have had a bigger impact. So it's very curious, and they don't get into why, but there are concerns that the FDIC is now underfunded by $70 billion that we're now having to pay out. So that's going to take 10 years to pay off that impact from the Silicon Valley, First Republic, et cetera, banks. So that's very concerning, and that's actually one of the areas that I continue to look for and monitor for weaknesses right now in the economy or the next potential liquidity risk, and that is smaller and regional banks. So smaller and regional banks have a number of headwinds against them right now. One of them is they have a lot of commercial real estate exposure. The positive news is that commercial real estate has been rebounding. Office is a little bit off of its lows. The problem is there is a maturity wall. A lot of those commercial real estate properties that did need refinancing in 21, 22, and even 23 just got restructured or delayed. And so that's a big concern, that at a certain point, if interest rates don't come down, then that's just delay the inevitable with some of those loans that need to be marked down to market much more aggressively than they have been. And I think that's a big part of my concern. If you go back to that November podcast that you and I recorded, and anyone who wants to catch up on some of these topics should go back and look at that, because the points are still the same. The U.S. government is going to be borrowing so much for so long into the future that it's going to have a big impact on the credit markets and on fixed income. It's going to mean that rates are higher than longer. And if those commercial real estate properties cannot get rolled at rates that are lower than they are today, then I think you're going to have some significant write-downs and potential defaults on that. So that's one area of concerns with the regional banks. I think the other concern is just with our federal government. I don't see a fiscal crisis in the U.S. government anytime soon. I mean, so long as we still have the reserve currency, so long as we can still print money and people will take it, The U.S. government also has one of the strongest, most resilient economies backing it up. So buying treasuries is a bet on on the strength of the U.S. economy, which has been a good bet historically. The other thing the U.S. government has a lot of, is, people don't realize, it has a ton of assets. The U.S. government, federal government, actually owns about 40% of the land in the United States. So there's any number of ways that, much to the chagrin probably of the Greens, that federal government could monetize that land any number of different ways, like selling mineral rights and so forth. So they have a lot of different ways to mitigate. The U.S. isn't the only government, though, that has a fiscal spending problem. There's a lot of other governments that do. There's a massive populist movement, not just in the U.S., but in other countries around the world. So I expect to see fiscal spending coming up, and I do expect to see that eventually have an impact in some fiscal spending situation somewhere. So it probably is not going to start in the U.S. But the funny thing is, when these sort of government debt crises evolve, it's because of a loss of confidence, and there's just no way to model confidence. When confidence goes, it goes very quickly. Just look at the pivot you had in France a week or two ago, and that's fairly, benign, really, in the scheme of things historically. So that's what you have to kind of keep an eye on is confidence in these different governments, and where are the potential pockets that you might want to avoid as an investor. But so those are the two. I think regional, smaller banks in the United States, and then I think government deficit spending globally is another area of concern. Either one of those could lead to a liquidity crunch, and it's especially concerning to me that still, we've talked a lot about these in this podcast, that there's an expectation that rates are going to trend lower in the near future. To this day, 80% of surveyed fund managers still expect 2 or more cuts in the U.S. this year. So there's still a lot of belief that the rates are going to come down faster than I still think they will.
So Grant, sticking with liquidity, are there things that Northern Trust can do to help clients and other market participants?
Yeah, I think this is a real strength of ours. This organization, for those that aren't familiar with it, was really born out of a bank crisis in 1893, when Northern actually ended up being the bank that was used by the World's Fair, which was called the Columbian Exposition here in Chicago. So that's where our heritage comes from, and it's something that we spend a lot of time thinking about, is how to help our clients manage through liquidity especially when there are liquidity crunches. So firstly, we run some really good money market funds through our asset management arm. Those are very well managed and really have an eye on trying to maintain liquidity through the entire investment cycle. In the capital markets area, we've helped a lot of our clients, and I just mentioned this, with their own management of their liquidity. So to help them with their own liquidity sleeve, usually in addition to a money fund product. We also have centrally cleared repurchase products as well. So if someone is coming into a repurchase agreement with cash, they want to invest cash, they'll actually get a collateralized basket of treasuries and earn a very high yield. On top of that, it's daily liquidity. It's an overnight product. So a lot of liquidity. Every day is a fresh day, and you can exit pretty much any time while the market's open. So I think that repo product, which is cleared by the Fixed Income Clearing Corporation, or FIC, I think our money funds and our ability to help clients direct invest. And then, certainly on the deposit side, right? We saw a lot of that. I was here at the bank when the financial crisis happened, and it was amazing how many of our clients were wiring or delivering money into this organization, because Northern Trust was, during the financial crisis, the largest bank that didn't have to cut dividends through that. So I think that's an area that we'll continue to talk about in our podcast and look for, but it's an area that we really want to be there to help our clients, if and when. It's more a matter of when, not if there's a liquidity crunch in one asset type or another.
So Grant, we did a podcast in April with Gerard Walsh, focusing on T+1. So we just went through the conversion recently where the U.S. markets, North American markets, went from T2 to T1. And there were some concerns about that impacting liquidity and just overall having a negative impact on just the processing in the markets. I can certainly say our teams have done a fantastic job, and I think our peers and other participants in the market have done a great job sort of managing us through that transition. What are you seeing? Anything surprise you? Any impacts that you are seeing around T+1, and in particular with liquidity?
No, it's actually been a fairly smooth transition. So we're about 3.5 weeks into it now, and the fail rates in the U.S. have been fairly low. I think people adapted really well. The biggest issue is just the difference between the U.S. settlement cycle and the rest of the world. And I think that's something that will have to evolve and change. Two outcomes from the shift to T1. One is I think that certain funds are going to have to change their settlement structure. So some of the UCITS, which are popular fund structures in Europe, probably going to move to T1 eventually, be my guess. I've already seen a few have moved to T1, but that's a big job to do. And then we are seeing increased demand in lending from ourselves, so helping fund managers by being able to lend some credit to smooth over if there's redemptions or fundings coming into or out of their the funds and the assets that they manage. So I think those are the two outcomes. And I think some of that will slowly go away, actually, when other markets also move to T+1, which is going to be the inevitable trend.
So given all that, are there things that investors should be doing, either doing more of or doing, start doing, that maybe they're not doing today?
I think the average investor needs to probably have more control over their liquidity, so having a little bit more management of their liquidity. I would not necessarily suggest that buying and holding treasuries is a bad thing right now. I think you have to pay attention to the auctions. We've had a couple of poor auctions, but if those auctions start to fail, that's going to lead to that crisis in confidence in the U.S. dollar. But I look at corporate balance sheet right now. Corporate balance sheets are extremely strong. Foreign investors actually right now are buying a lot of our investment grade debt in the United States. So it's about a $9 trillion market. The corporations, unlike the federal government, have done a heck of a job managing their balance sheet. So I think corporate debt right now is very good, strong spot to be. Yes, spreads are tight. IG spreads are inside of 100 basis points right now. But if you look at the health of the average corporation in the United States, very strong through and through. They did a lot of pairing of risk. A lot of CEOs talked about recession and their concern around it over in 2022 and 23. So very healthy. I will give you one quick stat that's pretty interesting. Free cash flow is a percentage of sales right now in the United States across the S&P 500. It's as high as it's ever been. It's about 14.5% free cash flow is a percentage of sales right now. That number in the 90s, I believe, was under 5% at one point. So if you actually look at valuation on free cash flow, it's not that expensive a market on a relative basis. So, I think you've got a lot of strength right now in the corporate market. And then I think too, where else would someone look to potentially hedge themselves out, given everything going on? I think emerging markets starting to come around. Emerging market debt, even in the last years, performed exceedingly well. So I think looking more at the emerging markets, I think small caps is going to be an area of growth. Morgan Stanley, for example, has a view in the S&P 600, which is the small cap index. Earnings going up markedly in 2025 and 2026, actually earnings growth higher than the S&P 500. Value tends to be a little bit better, when there's questions of liquidity. You talked about diversification. So your lowest correlated sectors since 1990 are going to be energy, utilities, and consumer staples. All of those are under 0.6 correlation to S&P 500. So that's another area I think to look at. And then the last thing would be commodities. So not just gold, but commodities in general and companies that make their money off of commodities. There's a lot of work, belts and suspenders, that China's doing in emerging markets that's going on to not only develop emerging and frontier markets, but if you just look at the pivot to renewable energy, that's also going to consume a lot of raw resources and natural resources.
So talking about resources, natural resources, I know we had talked back in May a lot about energy, and we've had some questions around biofuels. We didn't touch on that in that episode. Is there anything that you'd want to touch on there?
Yeah, I really glossed over biofuels and renewable fuels because they aren't going to have a big impact on the pivot to renewable energy. So I would encourage anyone that's missed that podcast to go back into it. We really went into a lot of detail on in depth in the energy market and the impact from AI, which is going to be a very heavy user of energy. The problem with biofuels is they are not sustainable in large scale. So this year in the United States, it's estimated that around half, I think it's about 49% of all soybean crop is going to be used to create renewable diesel. So renewable diesel is a refined a refining of the hydrocarbons that come out of soy, out of organics, and they are exactly the same at the molecular level of regular diesel. So you can actually use it like diesel fuel. So roughly 49% of all the soy all the beans that's going to be farmed in the U.S. and harvested this year is going to go into renewable diesel, and that renewable diesel will make up 5% of our total amount that we use in the United States. So it's not like we can, if you use every bean possible to make it and you get to 10%, it's not coming. And then you get all these questions like, why are we using land to build fuel when there's pockets of the world that have hunger crisis? What does it look like from, a use of our lands to just put everything in a soy and bean rotation, or soybean and corn rotation, commercially farmed? So you just have all these other concerns and issues with it. So that's really what it comes down to. To delineate, a biofuel is not refined as much as renewable. And so that's why like ethanol can't be used 100% in a gasoline engine. You can only use it to kind of top off for a certain percentage, usually less than 15% in gas. It's not the same molecular structure, and therefore it can't replace gasoline. It needs to be more refining to get it down to be able to replace gas. So it's not a scalable solution for renewables. It can help a little bit to offset some of it, but it's never going to be the be-all and end-all solution. That's why we didn't get into it.
So, Grant, we did a podcast recently where Gary Pollan interviewed somebody from the World Gold Council, and I know there's been some recent news in that space as well. Anything you wanted to touch on there?
Yeah, so gold's kind of been flat over the last month and a half. The biggest news is that China reported zero gold buying in May. So that's the first time in 18 months they haven't been buying a big buyer of gold. They were buying between 10 to 40 tons a month, which was a lot. They did for 18 months in a row. Based on the action right now I'm seeing in June, it looks like if they are buying, it's a moderate amount because the prices have kind of moderated around the 2,300 an ounce level. So that's a big change. The guess is China is as focused on the real estate crisis and putting more of their capital into there. That said, still on a recent survey, the central banks were surveyed, and 29% of them expect to add more gold to the reserve. So that's a relatively high number. I think it's the highest that number's been in about 10 years. So I do continue to see more buying from central banks. And really, at the end of the day, if you think about gold and why gold, it has a lot to do with supporting these fiat currencies. There's not a lot. There's no successor for reserve currency to the U.S. dollar. It's not going to be Bitcoin. It's not gold, right? It's going to be other currencies that compete against the U.S. dollar. And I think some of these central banks do want to put more gold and reserves behind them to support their fiat currency as an alternative. So that's where I think you're going to continue to see some gold buying. But right now it's moderated primarily because China has paused recently.
Grant, I just want to thank you for joining us today. We always appreciate your insights on what's going on in the markets, the potential risks our clients are facing, and some options for them to mitigate those risks. And always, I want to thank our listeners for joining us on Market Pulse by Faster Forward at Northern Trust. I look forward to seeing you on our next episode.